We are 6 days away from a potential government shutdown, and if you understand how commodity markets actually work, you should be paying very close attention to silver right now. Not because of conspiracy theories or internet hype, but because of a structural vulnerability in the physical silver market that most people don't realize exists. The COMEX, which is the primary exchange where silver futures are traded in the United States, operates on a system that assumes most contracts will be settled in cash rather than physical delivery. That assumption works perfectly fine until it doesn't, and a government shutdown creates exactly the kind of chain reaction that could expose just how fragile that assumption really is. Let's start with what most people misunderstand about precious metals markets. When you hear that silver is trading at $24 per ounce, that price isn't determined by people actually buying and selling physical silver bars. It's determined by futures contracts on the COMEX, where institutions, banks, and speculators trade paper promises to deliver silver at a future date. The vast majority of these contracts, somewhere around 98%, are never actually fulfilled with physical metal. They're settled in cash. The buyer pays or receives the difference between the contract price and the current market price, and everyone moves on. This system works because it provides liquidity and price discovery without the logistical nightmare of moving tons of physical metal around every time someone wants to trade. But here's the problem. The COMEX only holds a fraction of the silver that's theoretically promised through outstanding contracts. At any given time, there might be 400 million ounces of silver promised through open interest in futures contracts, but only 40 million ounces actually sitting in COMEX vaults available for delivery. That's a 10-to-1 ratio. The system functions smoothly because everyone knows that most traders will just settle in cash and roll their positions forward. It's the financial equivalent of a fractional reserve system. The entire structure depends on the assumption that only a small percentage of contract holders will ever actually demand physical delivery. Now let's talk about what happens during a government shutdown. The immediate effect is that certain federal agencies stop functioning or operate with skeleton crews. This includes agencies responsible for things like customs inspections, port operations, and regulatory oversight of commodity exchanges. When those agencies slow down or stop, the physical movement of goods across borders becomes unpredictable. Silver, like most commodities, is a global market. A significant portion of physical silver that would normally flow into COMEX warehouses comes from overseas, primarily from mining operations in Mexico, Peru, and Chile. If customs processing slows down or stops, those shipments get stuck. Here's where the math starts to matter. Under normal conditions, COMEX warehouses might receive 2 to 3 million ounces of physical silver per week to replenish what's being withdrawn for deliveries. During a shutdown, that flow could drop to near zero. Meanwhile, the demand for physical delivery doesn't necessarily stop. Industrial users, mints, and investors who hold contracts expecting delivery still want their silver. If the inflow drops to zero, but the outflow continues, you're looking at a rapidly shrinking inventory. With 40 million ounces in eligible inventory and a potential outflow of even 1 million ounces per day, you could see total available inventory cut in half within 3 weeks. The psychological shift happens when market participants start to realize this. Once traders understand that the normal replenishment mechanism is broken, the rational move is to demand physical delivery rather than settling in cash. Why would you accept a cash settlement at $24 per ounce when you suspect that physical silver might become unavailable at any price in the near future? This creates a self-reinforcing feedback loop. The more people who demand delivery, the faster the inventory drains. The faster the inventory drains, the more people want to lock in physical metal while they still can. This is the classic setup for a short squeeze, but in the physical commodity market rather than in equities. Let's put some numbers on what a short squeeze in silver could look like. Right now, with silver at $24 per ounce, a move to $50 would represent a gain of just over 100%. That sounds dramatic, but silver has done exactly that before. In 2011, silver went from $18 in late 2010 to nearly $50 by April 2011. That was a move driven primarily by investment demand and speculation, not by a genuine supply shortage. If we're talking about an actual delivery crisis, where the COMEX cannot fulfill its contractual obligations, the price could move much faster and much further. A move to $75 or $100 per ounce wouldn't be out of the question, because at that point, you're not dealing with normal market dynamics. You're dealing with a system failure where the price has to rise high enough to either bring new supply into the market immediately or to convince contract holders to settle in cash, rather than demanding metal that does not exist. Now, you might be thinking this sounds like a conspiracy theory or an overhyped scenario designed to sell silver. Let me give you the rational framework for why this isn't about conspiracy. It's about structural risk. The COMEX operates within a specific regulatory and logistical environment. That environment assumes continuous functioning of government services, stable international trade flows, and predictable behavior from market participants. A shutdown disrupts all three of those assumptions simultaneously. This isn't about whether the government wants silver prices to go up or down. It's about what happens when the infrastructure that supports a fractional reserve commodity system stops working as designed. Consider the concept of counterparty risk. When you hold a futures contract, you're not actually holding silver. You're holding a promise from the clearinghouse that you can either settle in cash or take delivery of physical metal at a specific price. That promise is only as good as the clearinghouse's ability to fulfill it. If the clearinghouse runs out of physical inventory and cannot source more due to customs delays, then the promise breaks down. At that point, the market has to reprice silver to reflect the actual scarcity of physical metal rather than the abundance of paper contracts. This repricing can happen very quickly because once confidence in the delivery mechanism is lost, the paper price becomes meaningless. The only price that matters is what someone with physical silver is willing to sell it for. Let's walk through a concrete scenario. Imagine you're a contract holder with a March delivery contract for 5,000 ounces of silver, currently priced at $24 per ounce, representing a contract value of $120,000. Under normal conditions, you'd probably just roll that contract forward or settle in cash, pocketing any gains or losses. But now it's 6 days before a shutdown, and you're hearing reports that customs is about to stop processing precious metal shipments. You call your broker and say you want physical delivery. Your broker checks with the clearinghouse and confirms that, yes, they can deliver your 5,000 ounces, but they mention that they've been getting a lot of similar requests and inventory is tighter than usual. Now multiply that scenario by 100 or 1,000 contract holders, all making the same decision simultaneously. The clearinghouse suddenly has requests for 5 million or 10 million ounces of physical delivery against an inventory of 40 million ounces. They can fulfill those requests, but now their inventory is down to 30 million ounces, and more requests are coming in. At some point, they have to make a decision. Do they honor all delivery requests and risk running completely out of inventory? Or do they start paying premiums to convince people to settle in cash instead? Either way, the price of silver has to rise to reflect this new reality. The term for this is backwardation, and it's one of the clearest signals of physical shortage in a commodity market. Backwardation occurs when the spot price of a commodity is higher than the futures price, indicating that people value immediate possession of the physical good more than a promise of future delivery. In normal silver markets, futures prices are slightly higher than spot prices due to storage costs and the time value of money. But when backwardation appears, it means the market is screaming that physical metal is scarce and valuable right now. If COMEX silver goes into sustained backwardation during a shutdown, it's a clear sign that the delivery mechanism is breaking down. Here's why this matters beyond just the price of silver. The COMEX is the primary price discovery mechanism for silver in the Western world. If the COMEX price becomes disconnected from the physical market, it creates chaos across every industry that uses silver. Electronics manufacturers who need silver for circuit boards, solar panel companies who need it for photovoltaic cells, medical companies who use it for antimicrobial applications, they all rely on the COMEX price as a reference point for their purchasing decisions. If that price suddenly becomes unreliable because it's based on paper contracts that can't be fulfilled, these companies have to scramble to source physical silver at whatever price they can find it. This cascades through supply chains and creates genuine economic disruption. Now let's talk about what parabolic actually means in the context of commodity prices. A parabolic move isn't just a big price increase, it's a specific type of price acceleration where each percentage gain happens faster than the last. If silver goes from $24 to $30 over a month, that's a 25% gain. If it then goes from $30 to $38 over 2 weeks, that's another 26% gain in half the time. If it then goes from $38 to $50 over 1 week, that's a 31% gain in a quarter of the time. That's parabolic. The rate of increase is accelerating. This happens in commodity markets when the physical shortage becomes severe enough that price is no longer the primary constraint on demand. At that point, people aren't asking, is silver worth $30 or $40, when they're asking, can I get any silver at all? The historical precedent for this exists. In 1980, silver went parabolic due to the Hunt brothers attempting to corner the market. The price went from $6 per ounce in January 1979 to $50 per ounce in January 1980. That's an 800% gain in 1 year, with most of the move happening in the final 3 months. The Hunt brothers were eventually stopped by regulatory intervention and margin requirement changes, but the price action demonstrated what happens when too many people try to claim physical silver that isn't available. The difference between then and now is that the current setup wouldn't be caused by market manipulation. It would be caused by a legitimate breakdown in the supply chain infrastructure that keeps the fractional reserve system functioning. So what does this mean for you as someone trying to build actual financial freedom rather than chasing short-term speculation? First, understand that we're talking about risk management, not gambling. Precious metals serve a specific role in a portfolio. They're insurance against system failure, currency debasement, and supply chain disruption. The normal allocation to precious metals for most people is somewhere between 5 and 10% of their investable assets. If you have a $100,000 portfolio, that means $5,000 to $10,000 in gold and silver combined. During normal times, that allocation just sits there, maybe goes up a little, maybe goes down a little, but mostly it's dead weight that doesn't compound like stocks or generate cash flow like bonds. But during times of genuine system stress, that 5 to 10% can preserve your purchasing power when everything else is falling apart. If we're 6 days from a shutdown that could trigger a delivery crisis in the silver market, the question isn't whether you should bet your entire portfolio on silver going parabolic. The question is whether your existing precious metals allocation is appropriately structured and whether you understand the difference between paper silver and physical silver. If you own silver through an ETF like SLV, you don't own physical silver. You own shares in a trust that claims to hold silver. If there's a delivery crisis at the COMEX, your ETF shares won't help you. They'll be caught in the same chaos as futures contracts. Physical silver, meaning coins or bars that you can hold in your hand or store in a private vault, is a different asset class during a crisis. The premium on physical silver over the paper spot price normally runs around $2 to $4 per ounce for retail purchases. During the March 2020 crisis, when COVID shut down mints and supply chains, that premium spiked to $8 to $12 per ounce. Some dealers were completely out of stock regardless of price. If we see a genuine COMEX delivery failure, that premium could go to $20 or $30 over spot, or physical could simply become unavailable at any premium because no one wants to sell into a market where they don't know if they'll be able to replace their inventory. Let's run the math on what this means in practical terms. Say you have $10,000 allocated to precious metals as part of a balanced portfolio. Under normal conditions, you'd split that between gold and silver, maybe 70-30 or 60-40, because gold is the primary monetary metal and silver is more volatile. With 6 days to a potential shutdown, the question is whether you should shift more toward physical silver specifically, and whether you should hold physical rather than paper. If you buy physical silver at $24 per ounce plus a $3 premium, you're paying $27 per ounce. If the COMEX breaks and silver goes to $50 spot with a $15 premium for physical, you're looking at $65 per ounce. That's a 140% gain on your position. But let's be clear about the risks. If the shutdown gets resolved quickly, if customs processing resumes, if new silver flows into COMEX warehouses and the delivery crisis never materializes, then silver probably just trades sideways or drifts lower. Your physical silver is still worth what you paid for it, minus the premium, and you're sitting on a dead asset that's not compounding. You haven't lost money, but you've given up opportunity cost. That $10,000 could have been in an S&P 500 index fund, earning 7% annually, which is $700 per year. So you have to weigh the potential for a 200% gain in a crisis scenario against the certainty of zero yield in a non-crisis scenario. This is why precious metals are insurance, not investment. You don't buy fire insurance hoping your house burns down. You buy it accepting that most years you'll pay premiums and get nothing in return. But in the year your house does burn down, the insurance pays for itself 100 times over. Silver works the same way. Most of the time it's dead weight in your portfolio. But when the financial system experiences genuine stress, it performs the function it's supposed to perform, which is preserving purchasing power when paper assets are failing. Now let's talk about the COMEX specifically, and why a breakdown there matters more than most people realize. The COMEX is part of the CME Group, which is the largest derivatives exchange in the world. It's a highly regulated institutional marketplace with clearing mechanisms designed to handle billions of dollars in daily trading volume. This isn't some fly-by-night operation. It's the backbone of commodity price discovery for metals, energy, and agricultural products. When something goes wrong at the COMEX, it doesn't just affect silver traders. It affects confidence in the entire commodity futures complex. If the COMEX cannot deliver physical silver as promised, it raises questions about whether they can deliver physical gold, copper, platinum, or any other commodity traded on the exchange. It forces market participants to ask whether the fractional reserve model that underpins modern commodity markets is actually viable during times of stress. That's a much bigger question than whether silver goes to $50 or $100. It's a question about whether the infrastructure of modern finance can function when the assumptions that infrastructure is built on stop being true. This connects to a broader concept that should matter to anyone trying to build long-term financial freedom. Modern financial markets are built on layers of abstraction. You don't invest in companies, you invest in shares of companies. You don't own commodities, you own contracts representing commodities. You don't hold cash, you hold digital claims to cash in a banking system that operates on fractional reserves. All of these layers of abstraction work perfectly well as long as everyone behaves predictably and the underlying infrastructure keeps functioning. But when something breaks in the infrastructure, those layers of abstraction become liabilities rather than conveniences. The COVID crisis in 2020 gave us a preview of this. When supply chains locked up, suddenly people cared about the difference between having toilet paper in their house versus having a claim to toilet paper that they could theoretically buy later. It sounds silly, but it's the same principle. During normal times, the claim is as good as the thing. During crisis times, only the thing matters. The same logic applies to financial assets. During normal times, a futures contract is as good as physical silver. During a delivery crisis, only physical silver matters, and the futures contract becomes a piece of paper promising something that can't be delivered. Here's the uncomfortable truth that most financial education doesn't address. The entire modern economy is optimized for efficiency rather than resilience. We've built systems that minimize inventory, reduce redundancy, and maximize the velocity of money and goods moving through the system. This creates enormous economic value during stable times. Companies can operate with just-in-time inventory, banks can operate with minimal reserves, exchanges can operate with fractional physical backing, and everyone benefits from the efficiency gains. But efficiency and resilience are inversely correlated. The more efficient a system becomes, the less able it is to handle disruption. A government shutdown is exactly the kind of disruption that exposes the trade-off between efficiency and resilience. Let's bring this back to your personal financial situation. If you're someone earning $70 or $90 or $120,000 per year, you're probably not thinking about COMEX delivery mechanisms or commodity market structure. You're thinking about whether you can afford a down payment on a house, whether your retirement account is on track, whether you should be doing something different with your money. The silver situation matters to you, not because you should become a precious metal speculator, but because it's a case study in how the systems you rely on for financial security are more fragile than they appear. When you invest in a retirement account, you're trusting that the financial markets will function normally for the next 20 or 30 years. When you hold cash in a bank, you're trusting that the fractional reserve banking system will remain solvent. When you buy index funds, you're trusting that the companies in those indices will continue to generate earnings and that the dollar will maintain its purchasing power. These are all reasonable assumptions most of the time. But they're still assumptions, and assumptions can break. The value of holding some portion of your wealth in physical assets that exist outside the banking system and outside the market infrastructure is that they continue to hold value even when the assumptions break down. This doesn't mean you should panic and convert your entire portfolio into silver coins and bury them in your backyard. That's the opposite of building financial freedom. It means you should understand the difference between assets that are claims on the financial system and assets that exist independent of the financial system. Most of your wealth should be in claims on the financial system because those assets compound and generate returns. But some portion should be in physical assets because those assets protect against system failure. The specific opportunity with silver right now, if you believe the government shutdown will happen and will last long enough to disrupt COMEX deliveries, is that you have about 6 days to position yourself ahead of what could be a significant repricing event. If you already have your 5 to 10% precious metals allocation and part of that is in physical silver, you're fine. You don't need to do anything. If you don't have that allocation, or if your precious metals exposure is entirely in paper assets like ETFs, then you might want to think about whether this is the right time to establish or adjust that position. But let's be very clear about the decision framework. You're not trying to get rich on silver. You're trying to ensure that if the worst case scenario plays out, you're not caught completely exposed. The worst case scenario here is that the COMEX cannot fulfill physical deliveries. Silver prices spike to $75 or $100 or higher. Industrial users can't source metal, supply chains for electronics and solar panels lock up, and the resulting chaos takes months to sort out. In that scenario, holding physical silver means you have an asset that's dramatically increased in value while most other assets are struggling. That increased value gives you optionality. You can sell some of it to take advantage of opportunities in other markets. You can hold it as purchasing power preservation, or you can use it as collateral if credit markets seize up. The best case scenario is that nothing happens. The shutdown gets averted at the last minute, or it happens, but gets resolved quickly, or it happens, but doesn't actually disrupt commodity flows, or it disrupts flows, but the COMEX has enough inventory to handle it. In that scenario, your physical silver just sits there, not compounding, not generating cash flow, but also not losing value. You've given up some opportunity cost, but you haven't lost your principal. The risk reward on this particular situation is asymmetric. Your downside is limited to the opportunity cost of holding a dead asset instead of a productive asset. Your upside is potentially a 200 or 300% gain in a short period if the delivery crisis materializes. That's the kind of asymmetric bet that's worth taking when you're allocating a small portion of your portfolio to insurance assets. You're not betting the farm. You're accepting that most of the time you'll earn zero return in exchange for protection against the times when everything else is failing. Now let's talk about what breaking the COMEX actually means in practical terms. It doesn't mean the exchange shuts down or goes bankrupt. It means the exchange is forced to admit that it cannot fulfill all delivery requests with physical metal, and it has to either change the rules mid-game or settle contracts in cash against the will of contract holders. Both of these outcomes destroy confidence in the integrity of the market. If the COMEX changes the rules, say by limiting the number of contracts that can be delivered or by forcing cash settlement, then traders know the game is rigged against them and they stop participating. If the COMEX just runs out of silver and defaults on deliveries, same result. Either way, the COMEX loses its status as the authoritative price discovery mechanism for silver, and the market fractures into a two-tier system where paper silver trades at one price and physical silver trades at a much higher price. We've seen this before in other commodity markets. During the 2007 to 2008 financial crisis, there were brief periods where the London Metal Exchange couldn't source enough physical metal to fulfill deliveries in certain industrial commodities. The exchange had to pay enormous premiums to convince warehouse owners to release metal into the system. Prices spiked, then corrected once new supply came online. The difference with silver is that silver supply is more constrained than most industrial metals. You can't just turn on new silver production overnight. Silver is mostly a byproduct of copper, lead, and zinc mining, which means silver supply responds slowly to price signals. If silver goes to $100 per ounce, mining companies will certainly increase production, but that increase takes months or years to come online. In the short term, the only way to balance supply and demand at $100 is for existing holders of silver to start selling. That means the price has to rise high enough to pull metal out of strong hands, to convince people who've been holding silver for years that now is the time to sell. Those are the people who understand that silver is insurance, who aren't trading it for short-term gains. They're not going to sell at $30 or $40. They might sell at $70 or $80 or $100 if they think the price has genuinely overshot and they can redeploy that capital into better opportunities. This brings us to the most important concept for understanding how to actually build wealth rather than just speculating on price movements. The goal isn't to own silver. The goal is to own optionality. Optionality means having the freedom to make decisions when opportunities arise. If you're fully invested in stocks and bonds and real estate and you have no dry powder, no liquid assets that you can deploy quickly, then you can't take advantage of opportunities when they present themselves. During the March 2020 crash, stocks were down 30 to 40% across the board. If you had cash, you could buy. If you didn't have cash, you just watched. 6 months later, stocks had recovered and were hitting new highs. The people who had cash in March made enormous returns in a short period. The people who were fully invested just rode the volatility. Physical silver is a form of dry powder. It's not as good as cash because you can't just use it to buy stocks without first selling it and converting it back to dollars. But it's better than being fully invested in assets that are illiquid or correlated with the broader market. If silver does go parabolic and you're holding physical, you can sell at $80 or $100, and suddenly you have capital to deploy into whatever looks cheap at that moment. Maybe stocks have sold off. Maybe real estate is in distress. Maybe there's a business opportunity that requires capital. Having liquid assets gives you the ability to act on these opportunities, and that ability compounds over time. Think about it this way. If you start with $100,000 and it compounds at 7% for 30 years, you end up with about $760,000. That's the default path of buy index funds and wait. But if during those 30 years you're able to identify 3 or 4 moments where having dry powder allows you to deploy capital at much higher returns, say 15 or 20% over a 3-year period, you can dramatically accelerate that timeline. One good deployment of capital at the right moment can be worth 5 years of normal compounding. That's what optionality buys you. The silver situation in the next week to 3 weeks is one of those potential moments. If the COMEX breaks and silver goes parabolic, people who positioned themselves with physical silver ahead of the crisis will have a windfall. They can take that windfall and deploy it into whatever assets look attractive once the chaos settles. If the COMEX doesn't break and silver just trades sideways, they've held insurance that didn't pay off this time, but they still have optionality for the next crisis. This is how you build wealth over decades. You maintain a buffer of capital in liquid or near liquid form. You watch for structural dislocations where risk-reward is heavily asymmetric, and you act decisively when those moments arise. Most people never get this because they're either too conservative or too aggressive. The too conservative people hold everything in cash and bonds, earning 2 or 3%, and they never take advantage of opportunities because they're afraid of risk. The too aggressive people are fully invested all the time, chasing returns, and when opportunities arise, they have nothing to deploy. The middle path is to be mostly invested in productive assets that compound, but to always maintain some allocation to insurance and dry powder so you can act when the moment demands it. The government shutdown and the potential COMEX delivery crisis is a test case for whether you understand this framework. If you're scrambling to buy silver in a panic right now, you're too late. The time to position was weeks or months ago when no one was paying attention. If you're completely ignoring this because you think precious metals are a scam or a distraction from real investing, you're missing the point. The point isn't whether silver is a good investment. The point is whether you're structured to benefit from dislocations in markets that you don't normally pay attention to. Here's the final piece of math that ties this all together. Let's say you're 35 years old with a $200,000 net worth. 5% of that is $10,000 in precious metals. If silver goes from $24 to $80 over the next month, your $10,000 position becomes roughly $30,000, assuming you're holding physical and can capture most of that move. That's a $20,000 gain. $20,000 might not sound like a lot compared to your total net worth, but it represents capital that you generated in 1 month from a position you were holding as insurance. That capital can now be redeployed. Let's say stocks have sold off 10% during the chaos. You sell your silver at $80, take your $30,000, and deploy it into a diversified stock portfolio. Stocks recover over the next year, giving you a 20% gain on that deployment. Your $30,000 becomes $36,000. You've now grown your original $10,000 insurance position into $36,000 of productive capital in just over a year. That $36,000 compounding at 7% for the next 25 years until you're 60 becomes about $195,000. That's the long-term value of making one good tactical decision at a moment of dislocation. Now multiply that by 3 or 4 such decisions over the course of your career. Maybe it's silver in 2025. Maybe it's real estate in a housing bust. Maybe it's distressed corporate bonds during a credit crisis. Maybe it's a private business opportunity during a recession. Each time you're able to deploy capital at advantageous terms because you maintained optionality, you're accelerating your compounding trajectory. This is how people actually build significant wealth. Not by finding one magic investment that goes up 10 times, by consistently positioning themselves to take advantage of moments when markets dislocate and risk-reward becomes heavily asymmetric. The government shutdown is just the catalyst. The COMEX delivery mechanism is just the specific vulnerability. When you find those situations, you size your position appropriately for the potential outcome. You don't bet more than you can afford to lose, and you wait. Most of the time, nothing happens and your capital just sits there. But when it does happen, you capture returns that can take years off your timeline to financial freedom. 6 days from now, we'll know whether this specific situation plays out or not. Whether it does or doesn't, the framework remains the same. Build your wealth primarily through productive assets that compound over decades. Maintain a buffer of insurance and dry powder so you're not caught exposed during crisis. Stay alert for structural vulnerabilities in markets that could create asymmetric opportunities. Act decisively when those opportunities present themselves. And never confuse speculation with strategy. Speculation is hoping silver goes up because you want to make money. Strategy is understanding that the fractional reserve commodity system has a specific breaking point, calculating the probability that we're approaching that breaking point, and positioning yourself accordingly with capital. You can afford to hold unproductively if you're wrong. That's the difference between people who build real financial freedom and people who just chase returns. Freedom comes from understanding systems, identifying vulnerabilities, maintaining optionality, and having the discipline to act only when the risk-reward justifies it. Everything else is noise.